Imagine a scenario where Solana is trading around $169 after a modest 6.4% pullback over the past week, finds itself perched at a familiar crossroads between consolidation and a potential surge toward new all-time highs. And that context becomes even more compelling when a fractal pattern nearly identical to one that propelled SOL up 70% in late 2024 emerges once more. This technical echo suggests that, should history successfully repeat, we could see Solana vaulting to $340, a gain of approximately 118% in the near term. At the heart of this bullish thesis lies a confluence of technical on-chain ecosystem and macro factors that, when aligned, have historically unleashed powerful rallies on the Solana network. The fractal in question appeared in Q4 2024, when SOL held firm above the $164 support zone throughout its upward trend, confirming the strength of that region, and then rebounded from $155 to $265. Now, SOL is again testing the same support range of $161, $166 identified by analyst Mary Emerald as the solid foundation for the mid-2025 leg that carried prices above $250 is trading within spitting distance of that zone. The validity of this support is reinforced by the recent activation of a golden cross on Solana's daily chart, where the shorter-term moving average has crossed above the longer-term moving average, often viewed by technical traders as a prelude to bullish momentum. Moreover, the MACD histogram on the 4-hour time frame has turned positive, with green bars indicating that upward momentum is building rather than waning. Taken together, these signals paint a picture of a market that has shrugged off the recent dip and is gearing up for a potential breakout. On-chain data adds an equally persuasive layer to the narrative. Over $200 million in value has recently bridged onto the Solana network, predominantly from Ethereum, approximately $113 million, but also with meaningful contributions of $37.73 million from Arbitrum and $24.86 million from Base. These inflows suggest growing demand for DeFi protocols and applications on Solana as users seek higher throughput, lower transaction fees, and the expanding ecosystem of staking, lending, and decentralized exchanges. CoinGlass further reports a net inflow of $17.21 million into Solana spot markets on August 6th, reflecting sustained accumulation rather than distribution, which aligns with the behavior of large investors preparing for a bullish move. A particularly telling development: a single whale purchased 71,000 SOL worth roughly $12 million, signaling that institutional or high-net-worth players are putting significant capital behind the network. When whales commit to such large acquisitions, they not only reduce available supply on exchanges, but also signal to smaller traders that the risk-reward profile at current levels is attractive, often catalyzing a self-fulfilling rally as retail participants step in to follow the smart money. Meanwhile, the broader Solana ecosystem is strengthening in ways that extend beyond raw token flows. Phantom, one of Solana's flagship wallets, has expanded its offering by acquiring SolSniper, a specialized on-chain analytics platform, effectively evolving Phantom into a more comprehensive financial hub. This strategic move enhances Phantom's capabilities in token analytics, real-time trading signals, and user wallet tracking, providing both retail and DeFi participants with advanced tools to navigate the network. As Phantom integrates these features, it solidifies its role as a critical infrastructure component, potentially accelerating user growth and on-chain activity. Rambunctious competition from rival blockchains notwithstanding, Solana's architecture, characterized by high throughput, sub-second finality, and negligible fees, continues to attract developers and projects seeking to scale decentralized applications. Protocol upgrades aimed at improving validator performance and cross-chain bridges that facilitate seamless movement of assets further buttress the argument that Solana is building the structural momentum necessary for sustained growth. Yet for every bullish argument, there exists a counter-argument grounded in risk. The fractal pattern itself, while alluring, does not guarantee a flawless replay. Markets are dynamic systems influenced by innumerable variables that can break patterns prematurely. So, must overcome resistance levels at $177 and $189 zones. That if they flip to support, would bolster the bullish case by creating a series of higher lows and higher highs that define an uptrend. However, should those levels prove insurmountable, they could instead morph into formidable ceilings that cap gains and trap momentum traders. A failure to reclaim $189 decisively might precipitate a retest of the $164–$166 support area. Breaches could trigger stop-loss cascades, forcing leveraged positions to liquidate and potentially driving prices back toward $150 or lower. Moreover, the Golden Cross, while indicative of shifting moving averages in favor of bulls, can lag price action and sometimes produce false signals in volatile markets, leading to whipsaws that punish overzealous buyers. On-chain data, too, must be interpreted with caution. While $200 million in bridged value is significant, the origins and ultimate destinations of these funds matter. If a portion of these assets are simply rotating through Solana to chase yield in temporary liquidity mining campaigns, or if they belong to yield farms that can unwind positions quickly, the net effect on price could be neutral or even bearish once incentives expire. Similarly, whales' activities such as the 71,000 SOL purchase may reflect a short-term accumulation strategy timed around specific catalysts, rather than a conviction in sustained long-term appreciation. If these large holders decide that the risk-reward profile no longer merits holding, they may offload their positions into any rally, flattening out price spikes. Ecosystem developments, while encouraging, are not invulnerable to delays or execution risk. The Phantom Sol Sniper merger, for instance, will need to translate into seamless integration and compelling user experiences. Otherwise, adoption may sputter, undermining the network effect. Broader DeFi projects on Solana must demonstrate not only user growth but also security robustness. Any high-profile exploit or smart contract vulnerability could shatter confidence, triggering a flight to safety that disproportionately affects networks perceived as less battle-tested than Ethereum. Competing platforms continually vie for market share. And if one gains a decisive technological edge, whether through interoperability, developer incentives, or regulatory clarity, capital may shift away from Solana, slowing or reversing the narrative of growth. Macro factors also exert a powerful influence over Solana's trajectory. Global liquidity conditions, shaped by central bank policies, can determine whether risk assets like cryptocurrencies thrive or languish. If major central banks pivot toward dovish stances, perhaps in response to moderating inflation or oxygen-starved, growth then capital may continue to flow into digital assets, providing the tailwinds necessary for SOL to make a sustained push beyond $200 and toward $340. Conversely, any hawkish surprises, such as renewed rate hikes or indications that quantitative tightening will accelerate, could tighten financial conditions, prompting investors to reduce exposure to volatile assets. Moreover, geopolitical events, from trade tensions to regional conflicts, can roil markets suddenly, and in such an environment, tokens like SOL, despite their technological promise, can experience swift corrections as investors seek liquidity and stability. Sentiment analysis underscores the fragility of mimetic exuberance. Solana's community remains highly engaged, with social media channels rife with enthusiastic discussions about Super Sol season and the next wave of decentralized applications. Positive narrative momentum can indeed amplify rallies, attracting new retail participants who chase the fear of missing out. However, sentiment can turn on a dime. Negative press about network congestion during peak usage, rumors of validator centralization, or criticisms of bridge security could rapidly erode trust and lead to sharp sell-offs. This duality of sentiment-driven volatility means that SOL's path to $340 is littered not only with technical and fundamental hurdles, but also with psychological ones. Liquidity. Dynamics on exchanges provide another prism through which to assess risk versus reward. Order book depth at incremental price levels from $170 through $180 to $200 and beyond. Beals. It's the real supply and demand landscape. If sizable buy walls materialize at successive thresholds, they can serve as springboards, absorbing sell pressure and enabling a stair-step ascent. But if those walls disappear, particularly during off-peak trading hours when liquidity is thin, then even modest sell orders can push prices sharply downward, scaring off momentum traders and causing a cascade of stop-loss triggers. Monitoring. These liquidity shifts in real time is crucial for anyone positioning for the potential rally.